Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
LIBOR is the daily reference rate based on the interest rates at which banks borrow unsecured funds from other banks in London, wholesale money market, or the interbank rate. So Roe measures this. I'm not going to spend a lot of time on this right now because I had so much material here that we're sort of running into overtime, but you can go back and notice that Roe does help you understand the interest rate differential. If the rates start to change, what should happen to the options, and call option by stock price or exchange rate, if you will. Here are the ISE-FX options prices. So if you take a look at it, and I took a screenshot of this was in December. Volatility was 14%, but the at-the-money options were trading around $1.79 bid at $1.94. The puts were much lower at $1.50, $1.68. Trading is dependent on forecasts, so you need to think about what are you predicting versus what is the market predicting. If you're looking for limited risk and you think the exchange rate might move up, you might be buying calls. If you think the exchange rate might be moving down in the case of the U.S. dollar being the base, you might be buying puts, or it could be against the, if it's the euro versus the dollar. If you think the euro is going down, you might be buying puts. You can buy call spreads if you're moderately bullish on the base currency. You can buy put spreads. You're moderately bearish on the base currency. So looking at CDD at 106.05, volatility is 13.75. You'll notice that, just about 5 or 6 weeks, we've seen the Canadian rate, the U.S. dollar Canadian drop from 106 to 104, and volatility go from 13 to about 11, actually almost 14 to 11. So we've seen a significant decrease in volatility. But anyway, you could look at these at-the-money options, and of course the calls are going to be, the highest ones are 102, cheapest are going to be the 110s, puts will be the reverse, going from highest strike price to lowest strike price. The Greeks define the various risks, so I can actually look at the call price, the delta. Again, the highest delta is the in-the-money call. If I look at the puts, the highest put gives me the highest delta. Then I could look at the gammas are going to be highest at the strike price. Betas are going to be highest at the strike price. The vega. So you notice that a lot of risks are at the strike price. Very interesting how that all works. So the summary of what I just presented, and again, I want to thank all of you for attending. I hope you thought this was a great presentation. I spent a lot of time on this one, going through all the option Greeks. So to summarize, delta gives you the rate of change of the option relative to 1 unit change in the underlying price. You might want to look at it as a percentage or decimal. Gamma tells me the rate of change of the delta relative to 1 unit change in the underlying price. And again, we're going to look at it as a decimal. Beta, the anticipated amount of time erosion per day. Again, the person that's long an option is going to lose money. The person that's short an option is going to actually pick up money, and we'll measure that in cents, of course, dollars. It could be decimal, but vega, we're going to also measure that in basically money or cents. And that is the expected amount of increase or decrease in options price based on 1 unit change in implied volatility. And Roe measures interest rate, so the likely amount of an increase or decrease in an options price based on a 1 unit change in the interest rate differential. Quotable: markets are constantly in a state of uncertainty and flux, and the money is made by discounting the obvious and betting on the unexpected. Right? This is what you're doing when you're trading options, essentially, is that you got to decide, do you want to predict what everybody else is predicting, which is fine, but understand the risks are involved, or looking at something else. That's up to you. summarize what I just spent the last hour on. So in summary, gaining a further understanding of the option Greeks can allow investors to understand the potential option pricing scenarios much easier. Understanding options pricing in the Greeks really gives you an advantage because you understand what might happen in the future. And then you could put your stop-loss orders in, or you could alter your trading strategies, your follow-up plan. All that stuff is intertwined. As investors learn more about options, you might want to react to varying scenarios. Investors can select the option strategies that best meet your own goals in view of your own risk tolerances. So the last summary is, and really what I'm trying to say is that a better understanding of the pricing model can help you incorporate your market expectations. It's always about the market's view of itself versus your view of the market. Then you decide your best course of action based on your risk-return trade-offs. Again, we just launched fxoptions.com, so please go and check out fxoptions.com. Lots there, whether it's the pair values, the implied volatility trader forum. We have trade alerts. We have Jason Ayers from optionsource.net that gives you the supply, the support and resistance areas of the currency pairs each week. We have weekly updates, the webinars, news. As I said, next Tuesday, John Yeagerson will be talking about timing your FX options, entry and exit points on Fibonacci analysis. And that's February 23rd, February 25th. We have Trading Central. On that, the Trading Central they'll be looking at their opinions of the market, and that'll be at 10 a.m. John, of course, will be back at the regularly scheduled 4:30 time slot Eastern. At this point, I want to try to answer all your questions. So thanks again. Please type them in. And I want to thank all of you for attending. So thanks again. Let me see if I can get to some of the questions.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.